Hello, all. I wanted to talk to you guys about accounting. I know for a lot of people, accounting can be very formidable and intimidating, and it really shouldn't be. It is a language. Um, and let's look at the definition together, if we could. It's the process of measuring, uh, interpreting, and communicating financial information to enable people inside and outside the firm to make informed decisions. Okay, so let's tear that apart a little bit. So it's a process, it's ongoing. The measuring is what you're going to get in your accounting classes. I'm not concerned that you know the difference between a debit and a credit because it varies based on whether you go into banking or whether you're talking accounting. So that is for another time. I'm more concerned with, do you know how to interpret that information? Do you know what that information is telling you so that you can make good decisions about your business or the business that you work for? Um, and that's the important thing. And can you then communicate it? All right. So let's go through some of the important parts that I want you to get out of this. First, let me just say that accounting is not difficult. It can be a little tedious, but it's addition, subtraction, multiplication, division, not complicated math. So those of you who are like, I don't like math, forget it. That's not the issue with accounting. The issue with accounting is it's very exacting, and so you have to be able to make sure everything equals out. So let's then that depends on the kind of accounting you're in. So let's go on. Let's talk about who uses accounting information, and it's all up on the slide. You can see it yourself. Um, and here's the thing, and I think this is a very helpful slide because it tells you what is it that each of these groups, what do they use the information for? Because their goals are different when looking at the information. So sometimes they want different information from one another even. I'm going to go on to talking to you guys about the different kinds of accountants. So there is a public accountant, a management, and a government accountant or not-for-profit. So public accountants are what they sound like, and you've heard of CPAs. You can be a public accountant, meaning you do deal with the public for their business, and you can be an accountant who has clients and not be a CPA. To be a CPA requires higher level of knowledge, and you're showing that by credentializing it, by taking this 3-day, that's right, 3-day exam, and in that to pass the CPA test, and along with additional hours of education and of work experience. And then you have the ability to charge a whole lot more per hour for your services. Management, and so CPAs can work inside or outside a company. Management accountants work primarily inside a company, and what they're looking for more is efficiency and effectiveness. How well are we doing, and where can we improve, or where is it that we're not doing as well as we should? And the numbers give them that information to help make different decisions. And then nonprofit accountants have different rules that they have to, and government accounting is done differently. And again, it's about the rules and who sets up the rules. Well, the FASB sets them up, the Financial Accounting Standards Board, and they're known as GAAP, Generally Accepted Accounting Principles. And those, like a language, if you ever learned language, there are rules to that language, and how you conjugate a verb and what goes first and so forth. And it's the same with accounting. It's like a language, and I say that to you because if you're ever going to borrow money for your business, or just talk to a banker at all, it's really helpful if they believe you understand money. And one of the ways you do that is by speaking their language, which would be accounting. All right. Let's move on. Let's talk about the accounting cycle. Fairly simple process. And again, there's single entry and dual entry accounting, and I'm going to tell you what those are in a moment. So an accounting cycle is whether you get a bill or whether you have sold something and you got an invoice. there's some kind of source document. And that source document, it's written here as basic data, you then record it. On this date, we got this bill for $228, and you just stick it in your journal. And journal is exactly what it sounds like. If you ever kept a diary or journal, it's a daily kind of reiteration of everything that happened that day. You're just keeping track of it, but it's not organized by accounts. So you'd have to go through and add and subtract over multiple days to get to how much is our balance in our accounts receivable or in our petty cash. So then there's something called a ledger, which is you take that information that's in your journal and you put it in your ledger. And you can think of a ledger as a filing cabinet with different files for everything, or a binder with different marks. So then you can easily know exactly where you stand in every account. So if you are using any kind of accounting software right now, just for your personal information, you might be using Quicken or Microsoft Money, or there's so many. They will do that step that you don't ever see it. So the recording, okay, then classifying, that happens automatically. Once you put in that you got this bill, it'll automatically journal and then put it in the ledger. So that's really helpful. And that's where then you create your financial statements. And we are going to focus on two of these more so than all four. You should at least know what the definitions are before we can even discuss anything. An asset, a liability, and owner's equity. And if you look at this accounting equation, and I want you to remember this, assets equals liabilities plus owner's equity, all it's really saying is that when you buy an asset, let's buy a house, okay? The house is worth $300,000. That house is worth $300,000 whether we have $300,000 in the bank to pay for that house or not. And like most people, we do not. In fact, we have about $50,000 to put down on it. That is our equity in the house, right? And so what's left? So it's another $250 we've got to borrow. That's our liability. And this changes over time. Let's say next year the house has gone up by $20,000. So now it's worth $320. Your asset is. Your liabilities have stayed the same or gone down a little bit, and your owner's equity is increased because the price of the house increased. So what you have to understand is this is an equation. What you do to one side, you have to do the other, just like algebra. And this is known as dual entry accounting. Many, many small businesses and individuals do not engage in this. For instance, if you pay your car payment, let's say it's $300, you pay it, you just write down in your, nobody even has a checkbook anymore, but whatever you keep track of it in, maybe an Excel spreadsheet, you write down $250, check number, date, and that's it. You don't go and say, well, how much is owing on my car now? How much went to principal? How much went to interest? You're only looking at one side of the equation. So that's single entry. Dual entry is where you're looking at both sides and making sure it all balances. Okay, so we're going to keep going. Let's talk about these different financial statements together. Balance sheet is the one, it is like a personal financial statement. It tells you what you own and what you owe. And the way it's set up is you've got your assets and then your liabilities and owner's equity. And so it is as of a date in time. So it's on this day, May 10th, this is the day. And on this day, this is what I have. This is what I own. So my assets are, and assets doesn't mean you own them outright. It means that's what they're worth. And then here's what I owe on them. And then here's what here's the equity I have in them, okay? The income statement is a little bit different. The income statement measures a period of time. So instead of a date, it's over a month, over a quarter, which is 3 months. It could be annual. So at that point, what you're looking at is during this period of time, I made $200,000. In order to make that $200,000, I had expenses. What were my expenses during that time? And there's cost of goods sold. If you're selling a product, if you're selling a service, there's no cost of goods, obviously, okay, because there's no good involved, there's service. And then, what was your net income or loss after paying all your bills based on order to make that amount of money? The statement of owner's equity, I'm just not that concerned with for what we're talking about. And all it's really showing you is, especially for small businesses, is how much equity and who has it. Statement of cash flows. This one's a little bit more important. This one is important if you have a lot of accounts receivable. So let's talk about what is an accounts receivable. It is an asset. It is work you've already done and they haven't paid you yet. So you did the work in February and here it is May and you still haven't gotten paid. Now, there's a couple of things you ought to know in this. Cash flow is the lifeblood, okay? You don't have enough money to pay your bills, you can't keep your doors open. And I don't know if you guys have ever heard the saying, I am doing so well, business is going so great, it's booming, but I have no money. What? Well, so if you are a heavy accounts receivable business, what will happen is you will need the tools and the time to do the work, but you won't get paid right away. And what that means is you've got to buy all the materials and commit the time and then do it for the next job and the next job, but they don't pay you for 30, 60, 70 days. And the question is, do you put down, let's say I get a job at Lowe's and they say every year I'm a plumber and every year we've got this thing we've got to get cleaned out and we need you to, every February we're going to need this job done. It pays pretty well, $15,000. It's kind of nice for my small business. So do I put it down when I do the job in February? Or do I put it down in May when they paid me? Neither answer is wrong. It just depends on whether or not you're using a cash-based accounting system or an accrual-based accounting system. In an accrual-based accounting system, you would put it down in February because that's when you did the job. That's most accurate. And all the expenses that you had would be related to that job. That's great, but it doesn't show you your cash flow, right? Because you didn't get paid yet, you just did the job. And so that means that the statement of cash flow is even more important if you're using an accrual-based business strategy with your accounting system. All right, my favorite, ratios. So ratios are just like you learned in 4th, 5th, 6th grade. Apples are to oranges, boys are to girls. And that's exactly what we're doing here. When you apply for a loan, they look at ratios. And what they're really looking at is other companies in your same industry, other businesses, at a certain income and asset level, within a range, how are they doing in these certain key areas? And that is the context in which they're going to compare how you're doing. Every industry is different. And those of you who've had some work experience out in the world, you know that every industry has its own way of doing things. And what's normal, quote normal, in one industry may not be normal in another. So let's look at the first ones. The first ones are liquidity ratios. And really what the current ratio is measuring is, can you pay your bills that are due right now, based on what you have that's a current asset. And a current asset is something that is of value, but within the course of a year can be turned into cash. That can be accounts receivable because if somebody owes you money and said more in a year, sorry friend, you're not getting it. It can also be stocks and bonds and cash. If I'm a florist, it can't be my van that I used to deliver things on, because I need that in order to run my business. Inventory is a part of that. I should be selling out my inventory more than once a year. And so that's all being measured in that. And the next one is the acid test or quick ratio. There's more things you can take away, but the quick and dirty one is right here. Basically, current assets minus inventory. If you got inventory that nobody wants, can you still pay people back? And so when you see 1.5 down there, what it means is you can pay your current bills 1.5 times over. And the 2.58 up top on the current, it means you can pay people. So you have 2.5 times as much money in your current assets as you do in your liabilities. So let's say it was 5 to 1. So you can pay people 5 times over. Is that good? I think we'd all say, yeah, that'd be great if I every month got paid and then my bills were, way down here. I could pay them over 5 times over with what I made. Here's the question though. Why do you have so much money just sitting around? That's what I would ask this company. Why aren't you investing it? Why isn't it working for you? So even though it seems like that would be a really good thing from the outside, something these all bring up questions. It's not that they're good or bad, and you don't know if it's good. This is the point I want to drive home with you guys. You don't know if it's good unless you know what the norm is in that industry. So let's go on to the next one. Talk activity ratios. And you can see over here, the average inventory is 5.13. Okay, so this is the number of times inventory runs through 5 times, and let's assume this is a year. Is that good or bad? I don't know. What's the norm? If the norm in the industry is 9 and mine is 5, my inventory isn't moving as fast as other people. Or maybe I'm spending too much money on shipping and so forth. So I've got to or carrying the wrong thing. So I got to figure out what's going on. And by the way, in here are also, sorry, I went the wrong way here. Things like accounts receivable. How many days is it taking you? Let's say I'm an architect and I did a job and it's been 45 days and I still haven't gotten my money. Is that good or bad? 50, 60 days now. Is good or bad? And your answer should be, we don't know until we know what the norm is in that industry. Well, the norm for architects is they're often the last to get paid. So if the norm is 65 days and I'm getting paid in 50 days, I'm a rock star. If I'm getting paid in 62 days, I'm still doing better. So I just want to know that I'm right in that range, okay? Profitability ratios measure how is this company doing based on a variety of factors, based on how much should we be making on this much in sales? What should be our gross profit margin and our net profit margin? And then return on equity. I've invested this much money, and what do I get in return? How is that doing? All right, and the last one I'm going to talk to you about is known as leverage. And leverage ratios measure the extent to which a firm relies on debt financing. I don't remember who said this, but years ago I heard someone say, when you owe a little bit of the money to the bank, that they're your creditors. When you owe a lot of money to the bank, they're your partner. And the difference is, and I mean a lot more than you and I are talking about, when you're a big company and you're borrowing tens of millions, if not more than that. So the leverage ratio is what percentage of your company is financed by debt, is in essence owned by the creditors, even though they don't own it. Did you have to pay them back? So if this ratio is 35.6, and what that means is 35.6% of the company is financed by debt. Is that good or bad? Again, I don't know without knowing what the norm in the industry was. If it was 65%, I'd say that was bad because I've lost all my flexibility now. The bankers, the lenders are my overlords because I owe them so much money. They basically own my company, except that I've borrowed money and have to pay them back. They're not interested in owning my company. I am going to stop here before the video cuts me off. But those are the big things I want you to know about accounting. A, it's not difficult. B, you need to understand how to speak the language, understand the terms that go with it, and then understand the financial statements and what they tell you. And they give you clues to be able to then use ratios to evaluate. All right? See y'all later.